If there is one lesson the market has taught me, it is this: the trend is not your enemy. Your impatience is. Men come into this game thinking they must outsmart the tape, predict every turn, and catch every swing. But tell me, why must you be smarter than the market when all the money is made by simply listening to it? You see, trends are not mysteries. They are the footprints of money, big money. And big money does not move in a hurry. It leaves a trail, a steady push, a rhythm. If you learn to recognize that rhythm, you don't need to guess. You only need to follow. But how many traders actually wait long enough to see that pattern unfold? How many rush in at the first flicker, mistaking noise for direction? The tape tells a story, but it whispers, it doesn't shout. A stock moving upward in a healthy trend will not behave like a wild animal. It climbs, pauses, breathes, and then climbs again. That pause, most men fear it. They think the move is over. They sell too soon. Or worse, they short a rising market because they think it has gone too high. Too high according to whom? I learned early that the market does not care about what seems reasonable. It does not care about your opinion, your analysis, or your need to be right. It only cares about supply and demand, and trends, true trends, are born when demand quietly overwhelms supply over time. Now let me ask you something. When you look at a chart, what do you actually see? Do you see lines and candles, or do you see behavior? Because if you're only seeing shapes, you're missing the entire game. A trend is behavior. It is the collective action of thousands, sometimes millions of participants reacting to information, emotion, and expectation. And here is where most go wrong. They focus on entry, not on understanding. They ask, where do I buy? Instead of asking, what is the market doing? A trend is not confirmed by one move. It is confirmed by consistency. Higher highs, higher lows. That is strength. Lower highs, lower lows. That is weakness. It sounds simple, doesn't it? But if it's so simple, why do so many fail to act on it? Because acting on it requires patience. And patience is the one thing most traders refuse to cultivate. I have seen men lose fortunes not because they were wrong, but because they were early. And being early in this business is the same as being wrong. The trend must prove itself. It must show you again and again that it intends to continue. Only then do you step in, not before. And once you are in, the real test begins. Because now you must sit. Can you sit with a winning position? Or do you take your profits the moment you see them, afraid they will vanish? Let me ask you, what is the point of identifying a trend if you do not stay with it? The big money is not in the buying or the selling. It is in the waiting. Now consider this: trends do not move in straight lines. They ebb and flow. They shake out the weak hands. They create doubt. A stock in a strong uptrend may pull back sharply. The inexperienced trader sees danger. The experienced one sees opportunity, or at the very least, sees nothing to fear yet, because he understands the structure of the trend. Do you? Can you distinguish between a healthy pullback and a true reversal? Or do you react to every fluctuation as if it were a signal? The market rewards those who can tell the difference, and that difference lies in context. A pullback that holds above previous support, that comes on lighter volume, that shows hesitation rather than panic, that is not weakness. That is the market catching its breath. But a break in structure, a failure to hold key levels, increasing volume on declines. Now that is a different story. That is the market telling you something has changed. And yet, how many traders ignore these signals because they are emotionally attached to their positions? You must understand this clearly: trends are impersonal. They do not care if you bought at the top or the bottom. They do not care if you are hopeful or fearful. The only question is, are you aligned with them? If you are, the market will pay you. If you are not, it will take from you. There is also the matter of time. Trends exist on multiple time frames. A stock may be in a long-term uptrend, but a short-term downtrend. Which one are you trading? Do you even know? Or are you mixing signals, confusing yourself, and then blaming the market for your losses? Clarity of intent is essential. A trader who does not know his time frame is like a sailor without a compass. He may move, but he has no direction. And then there is discipline. Because recognizing a trend is one thing. Following it is another. The market will test you. It will tempt you to act when you should wait, and to wait when you should act. It will show you profits and then take some of them back, just to see if you have the nerve to hold. Do you abandon your strategy the moment discomfort appears? Wealth in trading is not built on brilliance. It is built on consistency. On doing the same right thing, over and over again, even when it feels uncomfortable. Especially when it feels uncomfortable. A man who can identify trends but cannot control himself will never keep his profits. And a man who can control himself but does not understand trends will never make them. You need both. And let me tell you this, there will always be another opportunity, always another trend. The market is not going anywhere, but your capital. That can disappear quickly if you treat this game like a gamble. So why rush? Why force trades that are not there? Why not wait for the market to show its hand, to reveal its intention clearly? Because when you align yourself with a true trend, when you enter with patience and hold with discipline, something changes. You stop chasing. You stop guessing. You begin to operate with a quiet confidence, not because you know what will happen, but because you know how to respond. And that, more than anything, is what separates the professional from the amateur. A true trend is not born in a single burst of excitement. It does not announce itself with one dramatic move and then reward everyone who happens to notice. That is where most men are misled. They see a strong day, a sudden rise or fall, and they call it a trend. But let me ask you, since when did one move ever prove anything in the market? A single move is only a hint, nothing more. It is the market clearing its throat, not delivering its speech. The real message comes afterward in what follows. Does the price continue in the same direction? Does it hold its gains? Or does it give them back just as quickly? That is where the truth lies. You must learn to watch how price behaves after the initial move. If a stock rises sharply and then collapses back down, what does that tell you? It tells you there was no real demand behind it. Perhaps excitement, perhaps speculation, but not sustained buying. And without sustained buying, there can be no trend. But if the price rises, pauses, and then rises again, now you are seeing something different. You are seeing persistence. You are seeing intent. And intent is what creates trends. Consistency is the hallmark of a true trend. Higher highs and higher lows in an advancing market. Lower highs and lower lows in a declining one. It sounds simple, almost too simple. But simplicity is often what men distrust the most. Why is that? Because they are in a hurry. They want confirmation instantly. They want certainty where none exists. So they latch onto the first strong move they see and convince themselves that the trend has begun. But the market does not reward impatience. It punishes it. You must let the market prove itself. Think of it this way. If a man tells you something once, you might listen. But if he shows you the same behavior again and again, you begin to believe him. The market is no different. One move is a statement, repeated behavior is evidence. Now consider the structure of a trend. It is not a straight line. It is a series of advances and reactions. Each advance pushes into new ground, and each reaction tests whether that ground can be held. If the price holds above previous levels, and then pushes higher again, it is telling you that demand is still present. Do you see the difference? It is not the move itself that matters. It is what happens around that move. The pauses, the pullbacks, the way price responds to pressure. These are the details that reveal whether a trend is real or merely a passing fluctuation. Many traders fail because they ignore this structure. They buy strength without waiting for confirmation, or they sell weakness without understanding whether it will continue. They react to movement instead of interpreting it, and interpretation requires patience. You must give the market time to establish its pattern, time to show you that the movement is not accidental. Because real trends are built over time. They are the result of accumulation or distribution by those who have both the capital and the conviction to sustain their positions. And such people do not act in a single day. They act over days, weeks, sometimes months. Their activity creates the consistency you see on the chart. It is not random. It is deliberate. And if you are observant, you can follow it. But only if you are willing to wait. Let me ask you, how often have you entered a trade after one strong move, only to see it reverse shortly after. That is the cost of mistaking movement for trend. The market gave you a signal, but you treated it as confirmation. There is a difference, and that difference separates the informed trader from the hopeful one. A signal invites your attention. Confirmation earns your action, and consistency is confirmation. Patience in trading is not a passive act. It is not sitting idly and hoping something will happen. It is active observation. It is discipline held under pressure. And more than anything, it is the willingness to do nothing when nothing is clear. Most men cannot do this. They come to the market with the need to act. They feel that if they are not trading, they are not progressing. But let me ask you, since when did activity equal profit? The market does not pay you for being busy. It pays you for being right at the right time, and the right time only comes when the market reveals its direction. Before that, everything is guesswork. You may see movement, you may see volatility, but movement alone is not direction. A market can rise one day and fall the next, leaving you confused, exhausted, and poorer for the effort. This is what happens when you act without patience. You trade the noise instead of the signal. Patience is what allows the signal to emerge. You must learn to wait for clarity, not perfect clarity, because that does not exist, but enough evidence to tilt the odds in your favor. A series of higher highs and higher lows. A break of resistance that holds. A pullback that finds support and resumes upward. These are signs. These are the market speaking in a language you can understand. But it does not speak instantly. It takes time, and during that time, the impatient trader suffers. He jumps in early, convinced he sees the move before others do. He wants to be first, but being first is not the goal. Being right is. There is a cost to being early. Often, it is the same as being wrong. You see, when you enter before the trend is established, you are relying on hope. You are assuming the market will do what you expect. But the market owes you nothing. It will move as it pleases, not as you predict. So why not wait until it shows you? Why not let it prove that it intends to move in a certain direction? Because waiting feels uncomfortable. It feels like missed opportunity. You watch the price move without you, and you begin to think you are being left behind. That is when most traders abandon patience and chase the move. And that is when they make their worst decisions. Because when you chase, you are no longer thinking clearly. You are reacting. You are driven by fear, the fear of missing out, and fear has no place in sound judgment. Patience protects you from this. It keeps you grounded. It keeps you focused on what the market is actually doing, not what you wish it would do. It forces you to ask the right questions. Is the trend clear? Has it shown consistency? Is this move supported by structure? Or is it just a sudden burst? If you cannot answer these questions with confidence, then you have no business committing your capital. Capital is your ammunition. You do not fire it at shadows. The patient trader understands this. He waits for the moment when the market aligns with his criteria. And until then, he does nothing. Not because he is unsure, but because he is disciplined. There is a difference. Waiting is not hesitation. It is preparation. And when the moment finally comes, when the market has revealed its direction, when the pattern is clear, when the risk can be defined, that is when patience pays off. Because now you are not guessing. You are acting on evidence. And evidence is what gives you confidence. Not the kind of confidence that comes from hope or excitement, but the quiet kind. The kind that allows you to enter without anxiety and hold without panic. Because you know you did not rush. You know you waited for the market to show its hand. The majority of losses in this business do not come from being completely wrong. That is a hard truth for most men to accept. They believe failure comes from poor analysis, from lack of knowledge, from not understanding the market. But more often than not, the real cause is far simpler and far more dangerous. They act too soon. They see the beginnings of a move and assume the rest. They convince themselves they are ahead of the crowd, that they are catching the trend at its birth. But let me ask you, what is the value of being early if the market has not yet decided its direction? There is no reward for anticipation without confirmation. Being early means you are operating on expectation, not evidence. You are placing your capital on what you think will happen, not on what is actually happening. And the market has a way of punishing that kind of thinking. A stock may look strong for a moment. It may break upward, show promise, attract attention. But if that strength is not sustained, if it cannot hold its ground, then the move was never real to begin with. And those who entered early find themselves trapped, holding positions that no longer make sense. Now consider this. If you had waited, if you had allowed the market to prove its strength, would you still be in that position? Most likely not. This is where the difference lies. The patient trader waits for confirmation. The impatient one trades the possibility, and possibility is a poor foundation for decision-making. You must understand that the market is filled with false starts. It will show you moves that appear convincing, only to reverse shortly after. These are not accidents. They are part of the process. They are the market testing itself, shaking out weak hands, and searching for true direction. If you react to every one of these moves, you will find yourself constantly entering and exiting, taking small losses that add up over time. Not because you are incapable, but because you refuse to wait. Let me ask you, how many times have you entered a trade only to see it move against you almost immediately? And how often did that move later turn into a real trend? But without you, that is the cost of acting too soon. You were not wrong about the direction. You were wrong about the timing. And in trading, timing is everything. The market does not reward you for being correct in theory. It rewards you for being correct in practice. And that requires patience. It requires you to hold back until the evidence is clear, until the movement is not just a possibility but a probability. But men resist this. They want action. They want to feel involved. They believe that by entering early, they are gaining an advantage. But the truth is, they are increasing their risk. Because when you enter too soon, you have no support, no structure, no confirmation. You are exposed to every fluctuation, every doubt, every reversal, and that pressure often forces you to exit at the worst possible moment. The disciplined trader avoids this trap. He waits. He allows the market to move without him if necessary. He does not chase the first signal. He waits for the second, the third, the signs that show consistency, because he knows that missing the first part of a move is far less costly than being caught in a false one. Do you see the shift in thinking? It is no longer about catching the exact bottom or top. It is about entering when the odds are in your favor, and those odds improve only when the market has had time to establish its direction. Being early may satisfy your ego. It may make you feel clever, ahead of others. But the market does not pay for cleverness. It pays for discipline. And discipline often means letting the move begin without you. It means watching as others jump in, as the price fluctuates, as uncertainty plays out. It means resisting the urge to act until the picture becomes clear. Because when you finally do act, you are not relying on hope. You are relying on proof. A healthy trend does not move in a straight line. That is one of the first things a trader must accept, and yet it is one of the hardest lessons to live by. Men expect a trend to reward them continuously, without interruption. They believe that once a stock begins to rise, it should keep rising without pause. But let me ask you, what kind of market would that be if it never hesitated? There would be no opportunity, no test, no separation between the strong and the weak. Pullbacks are not accidents. They are part of the design. They are the market's way of testing conviction. When a stock moves higher and then begins to decline slightly, most traders feel discomfort. They question their position. They wonder if the move is over. And many of them sell, not because the trend has changed, but because they cannot tolerate the uncertainty. That is where they lose their advantage. A pullback in a healthy trend is simply a pause, a moment where the market digests its previous move. It allows late buyers to reconsider, early buyers to take partial profits, and new participants to enter. Without these pauses, the trend cannot sustain itself. But the inexperienced trader sees something else. He sees danger. He sees the price moving against him, even if only slightly, and he reacts. He exits too soon, giving up a position that may have taken time and effort to establish. And then, more often than not, he watches the market resume its direction without him. Now ask yourself, was the trend ever broken? or was it simply resting? The difference is everything. In a strong uptrend, pullbacks tend to respect certain levels. Previous resistance becomes support. The price may decline, but it does not collapse. It shows restraint. It slows as it approaches key areas, and then, if the trend is still intact, it turns upward again. That behavior is not weakness. It is control, and control is what defines a healthy trend. Volume also plays its part. During a pullback, you will often see lighter volume compared to the preceding advance. That tells you something important, that the selling pressure is not aggressive. It is not driven by urgency or fear. It is simply a natural reaction within the trend. But if the volume increases sharply during a decline, if the price falls quickly and breaks through support levels, then you must pay attention, because now the character of the market may be changing. Do you see how subtle this is? The market does not always give clear, dramatic signals. It requires observation. It requires you to look beyond the surface and understand the behavior beneath the price. Most traders do not do this. They react to movement without context. A red candle appears, and they assume the worst. They forget that trends are built on a series of advances and retreats. Without the retreats, the advances would not last. Let me ask you, can you sit through a pullback without losing confidence? Because that is one of the true tests of a trader. It is easy to hold a position when it is moving in your favor. Anyone can do that. But when the market turns slightly against you, when your profits begin to shrink, when doubt creeps in, that is when your discipline is tested. And most fail that test. They exit too early, only to re-enter later at a worse price or not at all. They allow short-term discomfort to override long-term opportunity. But the seasoned trader understands the nature of trends. He expects pullbacks. He plans for them. He does not panic when they occur, because he knows they are part of the process. He watches how the market behaves during those moments. He observes whether the structure holds, whether support remains intact, whether the selling pressure is controlled or chaotic, and based on that, he makes his decision, not on fear, not on impulse, but on evidence, because a pullback by itself means nothing. It is the context that gives it meaning. Price alone tells you where the market has been. Volume tells you how it got there, and if you ignore one in favor of the other, you are only seeing half the picture. Many traders watch price and believe they understand the trend, but let me ask you, what good is movement if you do not know the force behind it? A trend is not just direction, it is conviction, and conviction reveals itself through the relationship between price and volume. When a market is truly strong, price advances with support. It does not drift upward quietly without participation. It moves with intent. You will see expanding volume as price pushes higher, showing that demand is not only present but increasing. That is not air to be. That is interest. That is commitment. Now consider the opposite. If price rises but volume fades, what does that tell you? It tells you the move may lack strength. It may continue for a time, but without participation, it becomes fragile. And fragile trends do not last. Do you see the difference? It is not enough to say, the price is going up. You must ask, who is driving it? Because strong trends are built by those with capital, those who can sustain pressure over time, and their activity leaves a signature. It shows up in the volume. During an uptrend, you want to see volume increase on advances and decrease on pullbacks. That is the rhythm of strength. Buyers step in aggressively when price moves higher, and sellers retreat when it moves lower. This imbalance is what keeps the trend alive. But if you begin to see the opposite, heavy volume on declines and weak volume on advances, then something is shifting. The balance is changing. Supply may be starting to outweigh demand, and yet many traders ignore this. They focus only on price. They see a chart making higher highs and assume all is well, even as volume quietly tells a different story. That is how trends begin to weaken, subtly, without announcement. Let me ask you, would you rather react after the trend has clearly reversed, or observe the early signs that it is losing strength? Because volume often gives you those early signs. A sudden spike in volume at the top of a move can indicate exhaustion, a surge of activity where everyone rushes in at once. It may look like strength, but it can just as easily be the final push before the move fades. And on the other side, declining volume during a downtrend can signal that selling pressure is drying up, that the market is no longer eager to move lower. These are the small clues, the details that separate observation from assumption. But understanding this requires patience and attention. You cannot glance at a chart and expect to see it. You must study how price and volume interact over time. You must notice the patterns, the shifts, the changes in behavior. Because trends do not end abruptly without warning. They begin to weaken first. They show signs of hesitation, and those signs are often visible in the relationship between price and volume. Still, many traders choose to ignore them. Why? Because they are focused on outcome, not process. They want to know where the price will go, not how it is getting there. But the how is what gives you the edge. It tells you whether the move is supported or hollow. It tells you whether to stay, to enter, or to step aside, and most importantly, it keeps you grounded in reality. Not in hope, not in prediction, but in observation. Because the market is always communicating. Not in words, but in behavior. Price shows you the direction. Volume shows you the conviction. Emotions are the silent hand behind most trading decisions, and nowhere do they reveal themselves more clearly than in the way a man handles short-term fluctuations. A stock moves in his favor and he feels relief. It pulls back slightly, and that relief turns into anxiety. Now let me ask you, has anything truly changed in the trend, or has only your feeling about it changed? This is where most traders lose their way. They enter a position with a plan, with a reason grounded in analysis. But the moment the market begins to move, that plan starts to dissolve. Not because the market invalidated it, but because emotion stepped in. A small pullback feels larger than it is. A temporary pause feels like the end. And so they act, not on evidence, but on discomfort. Short-term fluctuations are part of every trend. They are natural, unavoidable. The market breathes. It expands and contracts, but the inexperienced trader treats every movement as if it carries equal importance. It does not. A few points against your position does not mean the trend has reversed. A brief period of consolidation does not mean the opportunity is gone. Yet how many traders react as if it does? They watch every tick. Every candle becomes a signal. Every dip becomes a threat. And in that state, it becomes impossible to think clearly. Decisions are no longer based on structure or behavior, but on fear. Fear of losing profits. Fear of being wrong. Fear of giving back what was gained. And so they exit. Too early. A position that was aligned with a larger trend is abandoned because of a smaller movement. And once out, they often watch as the market resumes its direction. Without them. Now what happens then? Regret. And regret leads to another poor decision. They chase the move, re-enter at a worse price, or hesitate and miss it entirely. All because they allowed a short-term fluctuation to override their original understanding. Let me ask you, if you cannot tolerate a normal pullback, how do you expect to hold a meaningful position? Because the real profits in trading do not come from catching small moves. They come from staying with a trend long enough for it to develop, and that requires the ability to endure temporary discomfort without losing perspective. Perspective is everything. You must learn to see the market in layers. The short-term movement exists within the larger trend. And unless that larger trend is broken, the smaller fluctuations should not dictate your actions. But this is easier said than done, because when money is involved, objectivity becomes difficult. A small loss feels personal. A pullback feels like a threat to your progress. And unless you have trained yourself to separate emotion from observation, you will react, and reaction is rarely profitable. The disciplined trader understands this. He expects fluctuations. He does not fear them, because he knows they are part of the structure. He has already considered the possibility of temporary movement against his position before he even enters the trade. So when it happens, he is not surprised. He does not rush to exit. He observes. He asks, has the structure changed? Has support been broken? Has the behavior of price shifted in a meaningful way? If the answer is no, then the fluctuation is just noise, and noise is to be ignored. But ignoring it requires control. Control over your impulses. Control over your need to act. control over the instinct to protect yourself from every small discomfort, because in trading, not all discomfort is danger. Sometimes, it is simply the cost of staying in the right position. A man may look at a chart and believe he understands what it is telling him. He sees price rising, falling, moving with apparent purpose. But let me ask you, over what span of time are you judging that movement? Because without that clarity, you are not analyzing the market, you are confusing yourself. A trend does not exist in isolation, it exists within a time frame. What appears as strength on a short chart may be nothing more than a minor reaction in a larger decline. And what looks like weakness in the moment may be a simple pause in a broader advance. So which one are you trading? This is where many go wrong.